Welcome to another edition of Coffee with Kirk. Appreciate you taking a little bit of time out of your day to listen to me yap about different stuff. And this week it was pretty much all about the Federal Reserve. Got a lot of great questions from clients, and their questions were basically the same as what all of Wall Street had is. What does the Fed cutting rates mean for the economy, the markets, everything like that? And of course, like anything in life, there's a lot of different opinions on it. So the Fed basically, what they said was, all right, well, inflation is moderating, which it is. So we have some room to cut rates. Even though we're cutting rates, we still see the economy's doing great. We're just trying to make sure that we're putting the economy in a position to continue to do well. So their inflation concerns are a little bit off. And what they're looking at is what they call the real return of interest rates. So, in theory, when you have inflation, say at 3%, in an ideal world, you'd get 1 or 2% above that as real growth on a fixed income investment. You certainly, if inflation's 3 and you're only getting a 2% bond yield, you're losing money to inflation. So you want something positive. So they're just saying, look, inflation's coming down, so we can bring rates down. It's going to, possibly put the economy in a position where it won't slow down. Now, Wall Street, lots of different opinions there. Some of them just say this is going to really, goose the stock markets. It's going to accelerate economic activity. Now, mortgages are a little bit cheaper. Auto loans are a little bit cheaper. The next camp is, well, it's probably going to be an inflationary because when you lower rates, the dollar is going to get weaker. So if the dollar that you hold in your hand is getting weaker, that means you can buy less goods and services. And then there's, the folks that say, look, this is we've seen this act before. And when you get to the point where the Fed is dropping rates, basically what that foretells is recession is oncoming. So what we're going to do is kind of take a look and see who's right in this and where it's going. And I don't know, but we'll look at history just to see what it looks like. And then I'll give you my opinion of where I think the economy's going. And if you watch the past couple Coffee with Kirks, you pretty much know I think we're heading to a slowdown, slowing growth, maybe not recessionary, but slowing growth, moderating inflation. Okay, and I do apologize. I have a little something going on with my didn't quite get a cold, but my voice is off a little bit. So if I sound a little funky, I apologize. But let's jump in and explore this a little bit. So here's a chart. Basically shows you all of when the Federal Reserve started cutting rates, and then what's the effect on the economy. So this goes all the way back to 1957. So any kind of period where you started to see the Fed cut rates. And you can kind of see that for the most part, the Fed's only going to start cutting rates when things get bad. When they start to panic a little bit, that's when they start to be accommodative on their interest rates. But there are some periods where that has not been the case, where the Fed has started to reduce interest rates and it did not cause a recession. So you can see 1966, 84, and then 95 and 98. So, speaking to the 1984, basically we were coming off the 70s and early 80s where we saw two really big recessions and a lot of inflation. So 81 was the last recession, and rates were still awfully high in 1984, but we had a lot of moderating inflation, and we had good economic growth. So when they started cutting there, it was almost more like a continuation of what was happening elsewhere in the economy. Pretty much the same thing for 95 and 98. So in both of those situations, well, in 1998, they cut rates because of the long-term capital management blow up. And we had a little bit of an Asian crisis. So it was really, they started to get accommodative because there were issues in some Asian currencies, and one hedge fund had way too much exposure to currencies, and it blew up in their face. So it really wasn't anything going on with the economy itself. I mean, the GDP was still growing at 3.7%. We had a nice savings rate as a country of 6.1. U.S. debt to GDP was only at 60%. And the unemployment was actually coming down. So when you see the periods that the Fed cutting rates did not cause a recession, if you look at the first column, the unemployed year over year, pretty much every time that it did not cause a recession, we had unemployment getting better. So unemployment was coming down in each of those periods. So that's kind of something to really look at. Now, of course, there are a couple periods where you say, well, it wasn't the case in 73, which is true. Unemployment was coming down, but that's what period where inflation was really rearing its ugly head at that point. So the Fed was cutting, but inflation reemerged, causing the 74 recession. So that was an interesting one on its own. And in the year 2000, unemployment was coming down a little bit, but we were heading into the tech bubble bursting at that point. So by the time the Fed started cutting rates, the economy was starting to turn over. And I am going to take a few drinks here, just give my voice a little help here. But anyway, what do we have today? Well, if you go to the very bottom, the blue block, unemployment, it's not getting better, it's getting worse. So unemployment is going up. Real GDP, well, at 2.6%, I still kind of feel like it's coming down a little bit. But we'll see, who knows? And then obviously U.S. debt to GDP is just ridiculous compared to where it's been in the past. And the savings rate is substantially lower than where it's been in previous periods. And really that's been the case ever since 2008, quite honestly. We've had a low savings rate for quite some time. So what does that mean? Well, the probability is that the Fed cutting rates would be a sign recession's coming, but it doesn't mean it absolutely is. And this is sort of a graphical representation of the chart I just showed you. So you can kind of see every little box here, whether that's a green box or a blue box of the S&P 500, you can sort of see that there are periods where the Fed cutting rates did not cause a recession. You still had extremely good market growth from there on, especially the 1995 through the 2000 period. The market still went up 200% from 1995 to 2000. But of course, in 2000, it dropped 42% from there. And then, of course, we all remember 2008. But even back in 1984, when they started cutting rates, the market tended to do very well from that point forward. You can kind of see the market in 83 was sort of trending down. Fed started cutting rates, market took off. And really the same in 1966. If you look at that, you started to see a little bit of a pullback in 65 in the market. Fed started to cut rates, market took off. So, you can make the case that by the Fed cutting rates here, that we're going to see the market just start to take off. If inflation continues to moderate and we still eke out some decent economic growth, lower rates are going to be a lubricant for the markets. Again, it should create some more economic activity. I know I talked to a friend of mine who works in mortgages, and he said he's already seen a pickup in mortgages. A lot of it is the people who purchased a house in the past couple of years when rates were north of 7% or even higher. Those folks are definitely coming to the table to refinance. At this point, we're looking at about 6.1. So you are starting to see some movement on that end. We'll see if this helps autos. The auto market, if you're looking to buy an auto, wait just a little bit longer. What we have in the auto market is there's not much activity, and I don't think it's so much a indication of interest rates as it was, coming out of COVID. People were paying above MSRP for cars. Now nobody's buying, but the dealers have yet to realize that they're going to have to drop prices. So we're at that point where I think they're going to come to their senses and prices will come down. And if they do come down while interest rates get lower, you're going to be able to buy a little bit more automobile. So anyway, let's jump to the next slide. And it shows that there is a good sign. In the past, when the Fed has cut interest rates with the market near all-time highs like it is today, it's actually been a pretty good indicator for future gains. So maybe that's what we're in for here. If you look at it, really the only time we saw it kind of indicate troubles ahead was in 08, or I'm sorry, 07, when the markets were kind of at all-time highs in 07. Fed started cutting rates, and then 08 happened. But for the most part, if the market's near all-time highs, the market continued to go higher once the Fed started cutting rates. Now, again, you can look at charts a million different ways. You can look at statistics a million different ways. But usually when the Fed starts cutting rates, they'll do it at 0.25%. They'll go slowly, they ease into it. So a 0.5% cut's a little bit bigger than what they normally get. So we say, well, what's happened in the past when we've seen the first cut by the Fed being a full 0.5%? And that one's not too pretty. The only time we've seen this happen since 1957 was in the year 2000, in 2007, late 2007. And then right before the COVID mess that hit in 2019. So that's a little bit different here. So you could say maybe the Fed's a little bit panicked and they're just not letting us know. And that's why they went with a 0.5% cut. I don't really know what their true intentions were. Nobody does. That's why everybody guesses and they sit and pour over every word that the Fed chairman talks about. So we'll see. I mean, I don't really know what's going to happen. Well, right after the Fed's decision, this is kind of the stock market. It took off at first. Excuse me. Jumped up 2%. But then by the close of business, within an hour, it was actually down. So gave up 2% plus. That was, what's the market thinking? Of course, the market the next day did very well, and then the market on Friday was down. So it's hard to tell in the short term. But the initial reaction was, hooray, we're getting a cut. And then I think the language from the Fed was like, well, this doesn't mean we're going to continue to cut. And also, I think people are worried, like when you go with a 50 basis cut, a 0.5%, like maybe the Fed's worried about something. Gold kind of did the same exact thing. When Fed first came out, boom, went right up, straight up. And then just as the stock market started coming down, gold came right back down too. So, the big thing, one camp of Wall Street is that this could actually result in the reemergence of inflation. And the key thing to watch is going to be the dollar. Now, the dollar lost some serious value in the Fed cut, but you can kind of see from this chart, this is the year for the dollar. The dollar's been in a downturn here for quite some time, really since July, well, probably June, I think. The dollar's been struggling, but it has struggled even harder with the cut. So when interest rates get cheaper here, the lower the interest rate goes, the less it's going to attract capital. You have less incentive if you're a foreign investor to come into the United States and invest if treasury yields are going down. So, the dollar is going to get weaker, which, like I said at the outset, if the dollar in your pocket is getting weaker, that means you can't buy as much goods and services. So we do need to watch and see. This could result in a reemergence of inflation, which the irony of that is on the political side of things, everyone's, the Fed's cutting rates because, they're trying to help Kamala Harris, and this is going to give her a boost. But the reality is, if this does result in some sort of inflation and gas prices go back up and food prices climb a little bit, that's probably the last thing that really Kamala Harris would want. The fact that a few people might be able to get into a house or buy a car, that's a smaller percentage of people that go to the gas station or go to the grocery store. So the last thing they want to see is prices starting to go back up. So, I don't think it was a political move, but, I don't know. I mean, the market had predicted at the start in January, they had predicted 10 cuts for this year, and they haven't gotten any until today or this week. So I'm not really think it's a political move so much. And I don't think it's going to help one way or another, quite honestly. But the thing to watch here, though, is what's the dollar doing? Because the initial reaction from the inflationary markets is we might see inflation reemerge a little bit. So the dollar losing value, while gold did give back gains the first day that the Fed announced, it has taken off since then. So gold, being the traditional inflationary hedge, is saying, hey, we think it could be inflation coming up. Now, gold has always sort of done well when the dollar has weakened. But, it's kind of saying, hey, maybe inflation is going to perk up a little bit here. And even commodities. This is just a chart of the Aberdeen all commodity strategy. This is the 24 most liquid commodities. Since the Fed announcement, it has bumped up drastically from about $19 a share to over 20. So, you talk a 5% move in just a couple of days, that could be a sign that the markets are now expecting inflation. What's happened with oil? Same thing. Oil was at it touched as low as 67 a barrel. Before the Fed announced, I think it was at 69. So it's gone up $2 a barrel just since the Fed announcement. So, there's parts of the market saying, hey, this could just turn around and be inflationary. Certainly something to watch and see how things go. But the bulls on Wall Street, they're saying, well, look, we've got about $6 trillion sitting in money market assets right now. Money markets have been yielding north of 4%, between 4 and 5%, depending on where you go. So investors have been fine to just sit back and collect some real interest. It's the first time we've been able to get any kind of decent interest on money market funds for quite some time. So there's a lot of money just sitting there in cash. If you can sit in an FDIC account and make 4.5%, 5%, made a lot of sense. Well, if the Fed starts chopping rates and that 4.5%, 5% starts dropping down, are investors going to go into the stock market or maybe real estate investment trust or something, high dividend paying stocks, trying to find a little bit higher yield? And when you had the Federal Reserve at near 0% interest rates, which we saw if you look at this chart from basically 2010 to 2017, we had low money market account balances at that point because they just weren't paying anything. You weren't getting anything north of 1% on your money. So you had to go into volatile assets. I mean, even if you could get 1.8% on the S&P 500 dividend yield, people were going for that. So there could be some serious tailwinds for the markets at this point if some of this cash starts to find its way into the stock market, into the real estate market. That's a potential. And it all depends on what the Fed does, what inflation does, and seriously what the economy is going to do at this point. So, that camp does have some validity too. So we could see inflation come up. We could just see a roaring bull market. But I tend to think that, history sort of shows that the Fed never really gets it right through a full cycle. The Fed always is late to raise interest rates, and they were this time as well. We had inflation getting way out of control before they started raising interest rates. So maybe they've kept interest rates, at that 5.25% for a long time. So maybe they're late to the party. And if they're late to the party, the higher interest rates may have caused economic damage. Interest rates are one of these things that they're like an aircraft carrier. You can't turn on a dime. You have to turn slowly. And their effect is felt later down the road. So there's a serious lag effect with interest rates. And I kind of think that that's where we're at. As I've been talking about pretty much this whole year, for most of the year, I couldn't tell if we were heading to a more inflationary environment or a deflationary. As soon as I thought I knew which way the economy was heading, things would turn and basically change my mind. But I still think we're heading for a slower economy and lower inflation too. So, I've talked about the reasons for this for some time now, but I'll just kind of really quickly go through some of it. And I just want to start with the fact that stocks are already pretty expensive relative to historical norms. This is the price to earnings ratio that I like to look at. It's called the Shiller price to earnings ratio. Robert Shiller is a Nobel Prize winning economist, and he did serious academic work that basically looked at the history of price to earnings, but he does something a little bit different. Rather than looking at the current price to earnings or trying to project what next year's price to earnings will be, he takes the past 10 years of earnings and basically averages it out so that you can see what's the price of the market today relative to this 10-year earnings cumulative effect. So it smooths out the earnings portion because earnings are very volatile. So what it shows is basically the price of the market today compared to what the earnings have been the past 10 years. We're pretty much near all-time highs on that. So when you're usually this high, it doesn't mean that things can't go further. You can obviously see the peak was the 2000 bubble. So we could conceivably see some juice and retouch those kind of levels. But you have to remember, when we hit that level in 2000, we basically had 10 years where the market went nowhere from that point. So these valuations, they don't tell you what's going to happen in the short term, but they do give you a very good idea of what kind of long-term effect or long-term return you're going to get as an investor. So stocks are already, kind of awfully expensive. So big moves up, I don't know if we'll see anything like that. And then when you take the Shiller price to earnings ratio, and then you overlap that with consumer sentiment, So usually when the price to earnings ratio is going up, you also have a very optimistic consumer, which you would think is kind of natural. If stock markets are going up, that's usually because people feel good about things and sentiment's awfully high. But what we have right now is a period where price to earnings is going up, but consumer sentiment is very, very low, and it's absolutely in recessionary territory. So that's another reason why I think we might be facing more of a slower growth environment. If people aren't confident in where things are headed, they're going to pull back even on the fringe a little bit of their spending. Another thing that's kind of come out recently, I don't like looking at dining out or even travel as a barometer of a recession. I've never talked about that in the past. I just saw this chart because somebody's saying, look, it has pulled back a lot for dining out. But if you look at this chart and really look at the numbers, the way to read this is that line where it says 100. That means, basically that's the average, that's the normal of what people are doing. And if you look at the chart, it may get, up to 102, 103 and come down to 98. So what it's really saying is you don't see a huge change one way or another. People are going to go out to eat. We've kind of been programmed now as Americans that, we like to go out. It's social for us. We like to go out with friends. We like to go out with family. It's good family time. I look at my life and, it's weird. Both my daughters hated going out to eat. It was one of the weird things. And when I was a kid back in the 70s and 80s, man, it was a treat because we didn't go out very often. So if we did go out, one, I knew my mom had a coupon. But two, it was, we loved it. It was really, really a treat for us. But for the most part, families, when they go out, it's time to spend time with family. But right now, my wife and I, pretty much every week, we'll go out to a local microbrewery and then grab dinner after. That's kind of our time to just sit and catch up on the week and spend time together. So I think people are, when you look at the chart, it has dropped a lot. And you can kind of see right after COVID, obviously it dropped a lot in COVID because restaurants just weren't open. And then once things opened, it went really way up there because people hadn't gone out to eat. But it has pulled back quite a bit recently. I think what you see during recessions is kind of people are still going to go out to eat. But some of them maybe, rather than just going out and grabbing Chick-fil-A for dinner, they might make something at home. You sort of see some of the fringe dining out go away. But core dining out has never done it. But we are starting to see people pull back on this. So the COVID honeymoon where everybody was going out is pulling back somewhat. But the other reason I kind of think we're sort of a late stage bull market and probably heading towards slowing growth, maybe recession, is just the sectors of the economy that are doing well in the stock market relative to, say, tech. So, basically technology has been the market the past 3 or 4 years, and they've gotten to absolute nosebleed levels. So, I, to my detriment, have kind of stayed away from tech because I just don't find a compelling valuation there. But even if you look at the charts, some of the sectors that we are now invested in that tend to do well when the market is shifting to late stage bull or even into bearish markets, one of them is utilities. So this chart, basically, it's a 6-month chart, and it looks at what have utilities done relative to tech. And you can see, utilities have really outperformed tech. But since July, it's been really apparent how much more this late stage sector has done relative to technology. Another sector that we've gone into here the past months is healthcare. Now, this is a 6-month chart, and Healthcare over the 6-month period has underperformed tech stocks by a couple percent. But what you want to look at, though, again, going back to July, when tech kind of reached its peak, healthcare has outperformed tech substantially from that point. Tech is actually down since July, whereas healthcare is up about 7%. Most of the gain that healthcare has gotten this year has come since July. So it's kind of a late stage view. And then also for consumer staples, the same thing. Consumer staples for this year so far, or the past 6 months, this chart, they've outperformed tech. But if you look at it from July, it's been a serious outperformance, whereas tech, again, is actually down about 3 or 4%. That's where consumer staples have basically put all 9% growth on. So those sectors are the ones that you typically go to, once things start to slow down. The other thing we've talked about is, bond yields. Even before the Fed started cutting, bonds have been dropping in yields. Now, this is the 10-year Treasury ETF. So remember, when this is going up, it means that bond yields are going down. So you can kind of see that the market, or the bond market, has been coming down in yields, which is typically the bond market saying we see less growth going forward. If the GDP was going up, people would be demanding a higher yield on their investment because of the higher growth. Because if the GDP is getting bigger, if the economy is growing, typically that means stock prices are going to do well because there's more economic activity. So as a bond investor, in order for you not to put your money into the stock market, there's going to have to be a higher bond yield to attract your money there. But we're seeing just the opposite. So when bond yields are coming down, that usually means the bond market sees slower growth. This is also a chart for the 20-year Treasury ETF, and the same thing has basically held since May. The bond market's seeing slower growth. The other thing we've been talking about, while inflation is still low, the trends are definitely changing where it is going up. So we're starting to see unemployment come up. Labor market conditions are coming down, and they're coming down pretty fast. We're also seeing a factor that I look at a lot is the temporary help. So this isn't like actual W-2 employees. This is when you need help. So you go to these temp sources, and they put somebody in there for 2 or 3 months. That's usually the first area that people are going to cut, because you're not necessarily going to want to cut one of your W-2 employees, but you can easily cut temporary services. And then a couple Coffee with Kirks ago, we talked about the SOM rule. Basically, that's looking at the rate of change in the unemployment rate over the past year. And every time this thing is triggered, it's been a perfect recession indicator. And of course, we had that trigger a couple months ago. Another reason credit card delinquencies are starting to pop, and it's happening from all age groups. This chart shows you everybody from 18 to 70 plus. And in every instance, we're starting to see these things go up. Now, they're not anywhere near the level that they were yet, say, in 2008, but they're definitely heading in the wrong direction. Same with auto loans. Auto loans, the same thing. They're popping the wrong way. And, they're getting to the point where we saw back in 2008. So, you just look at this thing. I think there's more factors now telling me things are slowing as opposed to that growth. Now, maybe the Fed cutting rates will resume growth. It could happen. But I think the picture's becoming clearer to me. The other thing to think about, too, is the second largest economy in the world is struggling, China. And this is a chart of their 10-year government bonds, and it's been heading south. And again, and this is actually a chart of their interest rate. This isn't like an ETF. So if you look, their interest rates are dropping. So again, if dropping interest rates typically means slowing economic activity, you can see that that's definitely happening in China. And probably even worse for China is their property values are dropping substantially. And they pulled back about 50% from their peak. And that's a big factor for China because, when you look at, this looks at, Japan, UK, Australia, the United States and Taiwan, along with China, like where do people put their money? And you can kind of see for the US, we have about 23% of our money in properties. We have about 15% in cash, 36% in stocks, excuse me, and 21% in other securities. Now for China, the vast majority of their household wealth is in real estate, 62% of it. So if they're seeing a downturn there, that really has an impact on the Chinese citizens. It's probably going to affect their economy. So, I always talk about, I try to figure out what quad are we in. And quad one is that situation where you do have rising economic activity and also rising inflation. So CPI is going up as well. And that's a good place to be. And it's natural. If the economy is booming, you'd also expect prices on all kinds of goods and services to go up as well. Quad two is sort of the perfect scenario because you have increasing economic activity, but you actually have the CPI or inflation moderating or coming down. So if you could have economic growth with prices coming down, that's the perfect location. Quad three is a bad area. It's called stagflation. It's where economic activity is slowing, but prices are going up. That's not a good place to be. And then quad four is both economic activity and prices are pulling back. And I think that's where we are. The good place to be in quad four is healthcare, consumer staples, utilities. So that's where we're focused on. The worst places to be are technology, energy, and industrials. So I still, the signs are telling me that's where we're at quad four. It's how bad will it be in quad four? It could just be economic activity slows and prices come back a little bit. It doesn't necessarily always mean recession. But that's usually where you start to see a potential for recession happen. And you get recessions too in quad three. If prices go up and economic activity slows, that's very bad. That's what you had throughout the 1970s and early 80s. So that's where I think we're at. As I've been saying here in the past few Coffee with Kirks, I've been liquidating all our oil positions. But I have to tell you, I still find unbelievably compelling reasons to invest in oil. I just don't know if momentum's with it right now. This is just a chart showing you the oil reserves. So Cushing is one of the largest oil reserves. It's in Cushing, Oklahoma, and they are near the bottom of their capacity. So the tanks are getting emptied there. This is a very busy chart, but this kind of shows you crude oil, the Cushing reserves, gasoline storage, and then distillates, which are chemicals used in manufacturing. This is month by month. You can kind of see, and lots of red for all these. So the top for crude, the past few months, the amount of reserves we have for crude oil has been going down. The Cushing, again, you see a lot of red there. So the amount of oil we have in reserves is going down. Same with gasoline, which shouldn't surprise you. Obviously, if our crude oil is going down, our gasoline is probably going to be doing the same. And even distillates are the same thing there, although not quite as bad. So we're in a position where we don't have as much in the tank for oil, which is usually pretty bullish for oil as you start to refill these. The other thing is right now, there's just not a lot of people who are long on oil. So we're really at a point where the number of longs, this is futures contracts, it's at all-time lows here, or at least lows going back, through 2010. Again, when everybody thinks the market's not going to go up, that's usually when the market goes up. And then the price of crude has basically deteriorated since June of 22, but even through this year, we kind of have seen the peak there in March, and it's just been downhill with some upward momentum since then. But the technicals on oil holdings isn't good right now, but the valuations and the fact that the Fed is cutting rates, which could cause some inflation, which would be good for oil. The fact that we don't have much in reserves is usually pretty good, that you're going to put some reserves back in there. Even if the price is low, you're like, well, let's fill our reserves now because prices are low. That will increase the price of oil. And of course, if all the investors think that oil is going to go down, typically the opposite happens. And this is a chart I showed you, I think a month ago, just showing you each of the 10 sectors of the S&P 500 and the valuations. And what we saw back then a month ago is oil is really cheap relative to its 15-year average. So right now, the price to earnings of energy a month ago, this is a month old. This is actually July 29th, the chart from July 29th. But I showed it to you in August. It was at 12.4 times earnings, whereas the historical average for energy is 19.3. So, it's cheap right now. So when you look at the other sectors of the economy, they're all pretty expensive relative to historical norms, with the exception of utilities, which is pretty much fairly priced relative to its history. So I do think I really still like oil. If I had to put money somewhere and I couldn't touch it for 10 years, I'd probably put it in oil and energy and just let it go. So I'm still very long-term bullish on it, but the short-term technicals aren't real good, but I'm watching. And we'll see, because a lot of these oil companies are generating a ton of cash flow. And at the end of the day, what you want as an investor is you want to pay as low price as you can for as much cash as you're going to get. It's like that in anything. So we'll see how this impacts oil, with the Fed cutting here. Past couple of days, it's been very good for oil, and we'll see if that continues. And then, of course, we always finish with our little lawyer say hello disclaimer. Okay, so let's jump in and see. A couple questions. So shopping for a new electricity contract. So in Maryland, for those who aren't in Maryland, it's one of the states where you can actually, you can get different suppliers for your energy. So saying shopping for a new electricity contract, rates are up significantly. Natural gas also. I don't see this changing in the near term, especially if there's no change in November. I would agree with that. Now, natural gas was one of these that really departed from oil. The price of natural gas dropped a lot. I mean, it was near lows through most of this year, and it's actually come up a little bit. It's still really low, but relative to the bottom, it's gone up. I think it was at 250 for the metric that they use for natural gas. I think now it's at 3. So it's actually up a little bit. And I do agree, like, the current administration has definitely curtailed the exploration here within our borders. Now, we haven't seen the real effects of that because it takes a long time from the point where you're given the okay to look at exploration and drilling to when the drills are active and to when the drills basically most of it's been pumped out. That's a long period. And I don't want to get political here, but President Trump opened up exploration, and it took a long time for that to start to pay off. So Biden's actually benefited. You'll see stats. Oh, we've pumped more oil the past year than we did during Trump. Well, yeah, because it takes time to get these things online. So even if we get a President Trump back in office and he wants to increase exploration here in the United States, we're going to feel the effects of Biden's policies through a good part of Trump's presidency if he's in. Now, if Harris wins, you're absolutely right in that we're probably not going to see a change. In fact, we're probably going to see much higher oil prices and natural gas because there won't be any exploration coming on. They'll continue to cut that. So the effects, I said interest rate cuts have a lag effect, but so do oil and energy exploration. They have a very long effect. And it also depends how well the wells produce, right? If you have one that produces much more than you expect, nobody knows exactly how they're going to produce. You have very intelligent geologists that are, trying to figure all that out, but you don't really know. So, but I do. That's another reason to be bullish on energy, and it's one of the reasons I am bullish on energy is we have cut the exploration, and for the next few years, we are going to see a slowdown in the amount of oil and natural gas that's going to come to market because of what's happened the past 3 or 4 years. Another comment, gold is up, but silver's gone vertical, and that's absolutely true. So the other thing to really look at when you get conditions like this, when the dollar's weakening, gold, silver, and mining stocks do very well. So mining stocks are almost a leverage play on the price of gold and silver. So I'm going to add a little bit into that. Mining stocks are the most volatile investments out there, but when you got the tailwinds, it's a very good investment to be in. So it looks like that's all the questions. So I appreciate your time, and thank you all for sending me these questions. I got a lot of questions after the Fed rate cuts. What's this mean? We'll see. I don't know. We'll find out as the data it comes in over the next weeks and months. But I still think we're in a slowing environment. I don't see that changing. Even if it does cause a little bit of an inflation upwards, I think overall economic activity is slowing. And I do think that even if we saw a little bit of inflation increase here, it's not going to be what we saw in 2021 and 2022. So I hope everybody has a great weekend. Take care, everybody.